I definitely I
How are you?
definitely missed you last week. I didn't take a laptop or anything down and didn't know whether or not we would have service or not. So thank Don for for the Lord Spirit working in him and whatever message he had. I'm sure it was from the pages of inspiration. We were talking about the flood, and I said, so needless to say, I wanted to talk about water this morning. It's from Matthew, the 14th chapter, and it's talking about, the caption is Jesus walks on the water. But I want to read this and just look at it from a different point of view. The 14:22 says, immediately Jesus made the disciples get into the boat. Well, when he said immediately, what had just occurred was that Jesus had fed the 5,000. So they fed the 5,000. They picked up the remains, which had 12 baskets of food that Jesus had the apostles to pick up. And so the scriptures, Matthew says, immediately after that, Jesus made them get into the boat and go ahead of him to the other side while he dismissed the crowd. And we know the crowd was, 5,000 or more. So it would take a long time, to dismiss them. And the 23rd verse says, after he had dismissed them, he went up to a mountainside by himself to pray. Just remember that Jesus went up after this ordeal happened. And then it said later that night, he was there alone, and the boat was already a considerable distance from land. And Matthew says, buffeted by the waves because the wind was against it. So they had left many hours earlier, but the scripture says, the mother, as Wendy mentioned, Mother Nature kept them from being able to get anywhere because the winds were so strong and they were going into that wind. So you had the wind and you had the waves and everything else. And the 25th verse says, shortly before dawn, Jesus went out to them, walking on the lake. Now the disciples were having a problem. Jesus didn't have a boat. He was up on a mountain, but being he is God, he understood and sensed that something was happening, with his people. So here Jesus comes down, from the mountain, not having a boat. And so he did what none of us could do. Jesus started to walk on the water. And so he started walking toward his disciples. The wind and the buffeting of that never stopped him, never slowed him down. And so he started walking toward the boat. And it says, when the disciples saw him walking on the lake, they were terrified. Well, they never saw God being exposed to some of the gifts and the power that he had. So he's walking on the water. That's not something any of us would be accustomed to seeing. And so therefore they're saying this cannot be a person, because, water and people walking on it is not a possibility. So they were terrified and thought it was a ghost. They said, and they cried out in fear. But Jesus immediately said to them, take courage. It is I. Don't be afraid. And so with that, the scripture says, Peter said, Lord, if it's you, tell me to come to you on the water. One of the things I would say after, looking at these verses is this, with Jesus, we cannot, have that doubt in our mind. Lord, if there's a God, Jesus, if there is a Jesus, do this for me or do this for me. Faith coming by hearing and hearing by the word of God. Faith is the substance of things hoped for, the evidence of things not seen. And so when we come to God, we can't have that double mind. If there is a God, I want to believe in you. You help me this time. And so the scripture says, Jesus just said, come, he said. Then Peter got down out of the boat, walked on the water, and came toward Jesus. But when he saw the wind, he was afraid, and beginning to sink, cried out, Lord, save me. Immediately, Jesus reached out his hand and caught him. You of little faith, he said, why did you doubt? And when they climbed into the boat, the wind died down. So all of us go through these trials and tribulations that we have in life. And many times God is there. He's rescuing us. And instead of us looking at him as being the rescuer, we look back at the troubles. We look back at the trials, the tribulations that we're going through, and we forget about the Lord, and we get back into the point where we were before he did the miracle to help us and assist us. So, I mean, the message I'm seeing this morning at this time is this: we put our faith in God, and he demonstrated that he will come down from where he is to be able to be with us, to carry us, to rescue us, to comfort us. We just have to have full faith in him. We cannot just say, well, maybe there is a God. If it is, let me pray to him this morning. Let me pray for him at this time. Let me see whether I can acknowledge him. He's not a passbook savings account, that you need him. You use him when you just need something. Put your faith completely in God. Trust him 100%. I mean, don't leave anything left out. And the scripture tells us about that. If we put our trust and faith in the Lord, he will not leave us, nor will he forsake us. So whatever we are going through, this morning, individually, family-wise, whatever, God is able to assist us in any of the problems that we have. We just have the faith to believe in him and trust him. And when the trials and the winds appears to blow even greater than they were before, don't put your mind and your faith on your troubles. Put your mind and your faith on Jesus, and Jesus will be able to carry you. And that's what he said to Peter. Peter, you just have little faith. Increase your faith, increase your trust, and God will take us through our trials. Let us pray. Father in heaven, we thank you for this day. Father, let us never take a moment of life for granted. Never have us, Father, look so far into the future that has yet to come that we forget about the trials and the struggles that we have on this day. And Father, we come to you and just ask you for, at this moment, at this time, Father, our faith, grow our faith in you, grow our trust in you. And Father, let us never leave you and never let us look so far into the future that we have yet to see and leave the confidence we have with you this day. Father, we still lift up the families in Waverly, those who had generational homes, who have lost them, families who have nowhere to live and nowhere to eat, and even to take a hot shower. And so, Father, we still lift these families up to you. And Father, for those of us who have, give us that heart of giving and thanksgiving to be able to assist those, who are without, because we never know when something like that can happen to us. And let us be givers, fathers, and not receivers. And so we just praise you. We lift you up this morning. Father, please increase our faith. Make us one that we can be your hands and your feet on this earth in which we dwell. And we lift you up in Jesus' name. Amen.
Amen. That was awesome, Tom, as it always is. Your message is always spot on. This reminds me so much of and I shared this with my King City people yesterday. As Christians, we we think that we're finally over the hump. Now we're Christians, everything's going to be great. It gets tougher.
Amen.
It doesn't get easier. It gets tougher. And, we need to be even more diligent
Amen.
about following him and seeking his direction, for what he would have us do. At this meeting that I was at, this mastermind that I was at in Utah, in the gym, I met this guy who was also in the mastermind, and we had talked a little bit, but yesterday, was the last day. We had a little more time to speak to each other, and we, of course, started talking about our businesses and what we're doing. And he said, "Let me tell you my story." He was he's how old is he? He's in his probably mid 40s right now, maybe late 40s right now. A black man from Jacksonville, Florida. He said his mother raised him, always told him to be entrepreneurs. He thought that meant some kind of dinosaur because entrepreneur was a weird word for him. It sounded like Tyrannosaurus Rex or something. He started laughing. He said, "I took my entrepreneurial spirit and I put it into drug trafficking." And at the age of 18, he was he was a pretty big drug trafficker and ended up getting caught and was facing a life sentence. That's how deep he was into it. But because of his age, the judge gave him 27 years. He said he was raised a Christian, but he, veered off, of course. And when he was in prison for 27 years, he not only got his associates and his bachelor's degree, but he got 2 doctorates, and he got them in international business studies. So he gets out of prison. He's 37 years old when he finally gets out, and he starts this company. This was in the early 2000s, started a real estate company, started wholesaling, actually. Worked his way up in wholesaling. We all know that wholesaling, in my opinion, is the toughest way to go in this business, which is why a lot of people cut their teeth on it. And he started growing, and just all kinds of things were happening, and he was getting bigger and bigger. And he got to the point where he was a believer, but all he was doing was thinking about that almighty dollar, and really just consumed by his business. And he left work in 2008 and fell asleep because he was so weary from what he was doing, and ran into the back of a dump truck, almost severed his leg, broke several bones, was in a coma for 4 months. And he said when he came out of that coma, he felt like he said, "I felt like I was having a trip with God," is the way he put it. And God gave him a vision to be a teacher and an educator, and stop being a wholesaler, to be a teacher and an educator, and to make sure that his business was God's business, not his anymore. It turned everything around for him. And as he's sitting there telling me his story, he starts crying. I mean, and this is a big guy. He probably 230 pounds and 6'3". I mean, he's a big guy, just boo-hooing about how God's changed his life, how he was already a Christian, and then God showed him that he was not walking his walk. And so it's tragedy like the flood that you're talking about, that can, all kinds of things like that just bring us closer to him. That we take what we think are failures, they're not failures, or tragedies, and turn them into just God trying to, put a noose around us and bring us closer, draw us closer to him. So it was a really cool interaction that I got to have with him. We prayed together in the gym. Everybody around us was looking at us like we were weird, but it was okay. I was fine with that. So I guess I'm sharing this because I think it's important that not only do we keep our eyes open to other people that are going through things like this, but we also need to continue to look in that mirror and question, like I did this morning on the way in, why am I so focused on making sure that this 1031 exchange is done so perfectly and so correctly, and that I'm picking the right thing? What is it that God really wants me to do with that? So thank you, Tom. I really appreciate that so much. Okay. I know that I saw Bryan Maddex. There you are. So, Bryan, thank you so much, for agreeing, especially when I put you on the spot, to come back and talk to us again about numbers and real estate. And I do want to thank you for turning me on to Barry Habib. I got to tell you, that guy is smart. And I've told so many other people I've sent your email out to so many other people to listen to that guy. It's amazing. Um, the Not only the information in his head, but the charts and everything that he shows you, he can back up what he says.
All in the data.
Really good stuff. Thank you so much for that. I really appreciate it.
Yeah, I've watched him. I've watched him probably for about 6 years. You can subscribe to daily emails and updates. It's about $170 a month to get access to his data. But his data gives me such insight on the market and what's coming and what's going. And almost every presentation I've ever done in front of Sonrisers has been peppered with info that he's given me. I mean, that's a majority, I would say. I'll do a little bit of my own research. I'll bring in some forecasting from the company and from Fannie and other sources, but I would say 75% of what I say is coming from Barry and the data he's shown.
It's
So, and
amazing.
he's been spot on,
Yeah,
So,
no doubt, no doubt. All right. Well, the floor is yours, my friend.
well, thank you for having me. And yeah, it wasn't hard to say, yeah, I'll speak when you asked in front of everybody 2 weeks ago. I guess I'm on the spot and I got to do it. I have a presentation that I've been doing as main meetings for a couple of RIAs and subgroups. I joined the Greensboro RIA, and I'm looking to start doing some more RIA speaking because it's just good for me. It's a good room to be speaking in, and for RIA members, it brings hopefully a lot of value and a lot of stuff that they just don't hear other mortgage lenders talk about. So today I kind of thought that I would do a 2-hour presentation in 45 minutes. So I'm going to skip through some of it. And some of it might be a little repeated from other times that I've spoken. It's hard to remember because Wendy, thank you. You have me ask me to speak every once in a while. So some of this data might be a little bit repetitive. Hopefully there's some interesting updates or twerks as I've kind of massaged it a bit. And then I wanted to show some current data and play a would you game. All right. So if you guys have questions, please throw it in the chat or unmute and just say it. The interaction to me means we're speaking on things you want to hear about and not things that I think you might want to hear about. So I'd rather answer questions because that's more in tune with what you guys might want. So I'm going to share my screen. All right. You guys know me if you've been coming to this meeting for any length of time. But I'm going to go over kind of a recap of what traditional financing looks like, look at some non-traditional financing, and then a couple of hacks that, again, I've been to lots of meetings. I've heard lots of other mortgage people and other lenders speak, and I don't ever hear this kind of data. So I try to bring stuff that's fresh and different. We play with rules and we play inside the rules, but when you play inside the rules, you can find out how to cheat legally. And I'm all about trying to take advantage. So if you don't know me, I've been in the business since 2013, technically as mortgage, but I started my career in retail banking in 1997. I did my first refinance in 97, and rates had just come down to 8%. And for the next 10 years, I just refinanced the same customers and new customers over and over and over, all the way down into the threes, right? But it was great getting into the business when rates were just coming down to 8%. It gave a lot of opportunity for refinances. Last year was a stellar year. We closed $100 million. We helped 405 families. That puts us in the very top of the top 1% of mortgage origination teams. So we had a great year. This year, I'm at about 68 million in funding. So I don't think I'll break last year's records, but rates are a little bit higher and there's no inventory. So it's a hard year. Most lenders are down considerably. I'm down a little. I'll take down a little versus down considerably from last year for most lenders. I've added some extra teammates to my team. So I've got 13 teammates. We're licensed now in 7 states. I actually do have access to Georgia through my junior loan officer. He would be the loan officer of record. but I'll be adding Texas and Colorado probably both next year. And I am an investor. I have a self-directed IRA. I have hard money loans out right now. I have investments into fintech companies out of my IRA. It's a checkbook IRA, so I have a lot of control, which is scary. I've had long-term rentals. I've always moved and rented the last house I had. Best way to be a real estate investor: move and don't sell, right? There you go. Now you have a home, and that's really how it's easy to start. Or purchase your first home as multifamily, or house hack your first home, and let other people start paying your rent. I currently own four short-term rentals, and I've got a fifth one that should be done in December. Wendy one time said, "Practice what you preach." And I was selling some long-term rentals, and she was like, "You're selling real estate?" I'm like, "Yeah, well, it was a plan." I was transitioning to short-term rentals, and taking out some equity because it was a good time. So real quickly, high-level overview of what traditional financing looks. And traditional financing, we're going to say, is Fannie and Freddie for investors. That's your main financing options, is Fannie and Freddie. And I say it's the gold standard. Fully amortized. That means there's no balloon payments, 30-year fixed rate. That means your payment ain't going up, right? Your tax and insurance might, but your cost of money is locked in as soon as you close for up to 30 years. Right now, I'm getting mortgages that I never want to pay off, right? Because rates are so dang good. I want this money outstanding forever. I used to pay extra on my mortgage and be like, "Oh, I don't want to have debt." I've changed my tune. I want as much debt as I can get if it's real estate debt. So on average, 620 to 720 is the minimum credit score, depending on how many properties you have. Everything that we do from Fannie Mae is full doc. So any tax returns, bank statements, pay stubs, all that fun stuff. You can finance up to 10 mortgaged properties. And a lot of people don't exactly know what that means. Sometimes it sounds, they'll ask me about, "Oh, can I have 10 mortgages?" And the answer is no, you can't have 10 mortgages. You can have 10 mortgaged properties. You could have one mortgage that's got a blanket lien on 5 properties, right? So that's one mortgage, but that's 5 mortgaged properties. So the way Fannie Mae looks is they want to know how many mortgaged properties you have. You could have 3 mortgages per property. That's okay. If you can get someone to do a third, go at it. But for the first 4 properties you purchase, if they're investment, you have to put at least 15% down. On the 5th through the 10th, if you purchase them as investment properties, you have to put 25% down. And multifamily properties, unless it's owner occupied and you do FHA, which you can do 3.5% down on FHA as owner occupied, you have to put 25% down on all multifamily properties. Reserve requirements. Reserves are payments in the bank. So how many payments do you have in the bank? You've got to have between, well, and in this case, they redefined what reserves was. We used to think of payments in the bank, and now it's a percent of outstanding mortgage debt that you have. So if you have $1 million in debt, but it's only 2 mortgages, you only need 20 grand in reserves. But if it's 10 mortgages, you need 60 grand in reserves. So it can make a big difference depending on how many mortgages you have. That sliding scale goes from 2 to 4 to 6% for reserves. So it just depends on how many mortgages you have. Investment rates are going to be, they're actually a little bit lower than this now. When I wrote this slide, Fannie and Freddie were still restricting how many second home and investment properties that they would purchase from mortgage lenders. And they've just lifted that restriction. So now we can do an unlimited amount of production as second homes and investment homes. And that pushed the rates down. We're probably in the low to high 4s is probably the main spread for interest rates for investment properties right now. And we can close in as little as 21 days. So not a cash offer, but the average mortgage right now in America takes about 46 days to close. So 21 days is still going to be on the leading edge. Any questions on traditional financing? Nobody? Okay. I'm going to burn through these first slides because they're the boring ones. So non-traditional financing. There's so many new ways to borrow money. Last week, there was a couple of great lenders that I wrote down that do Airbnb lending. And that's new. That didn't used to exist 2 years ago. They didn't have Airbnb specific lenders, but there's so many new ways to borrow money. In general, you've got non-QM lending, which used to be subprime. That's going to be your creative financing options. Bank statement to verify income, 1 day out of bankruptcy. A dockless loan. Dockless is not all the way dockless anymore, but it's no tax returns, no pay stubs. They just look at the rent you're bringing in versus the payment on the subject property. And if rent exceeds payment, you qualify. And then there's a credit pull. Hard money loans, I would say that's, gotten cheaper, but I would think a hard money loan is really 8 to 20% is interest rates. You've got your bigger companies, your medium companies, and then your private money lenders kind of all in that hard money. There's kind of soft money now. Some of the hard money lenders turned into, I call it soft money. Your Lima ones and your lending one, they have long-term financing options now. Some of the rates can get down to 5%. The big difference is they're typically going to have prepayment penalties. And the benefits are you're normally not going to finance in your personal name. They're going to finance those properties in your LLC, which a lot of people look for. So those alternative lending options are much cheaper than they were and much more available than they were. Access to money is really, money's flowing. Wendy's shaking her head. It is, it's just flowing. You have access to money right now in many forms. None of them are best, except for Fannie Mae, I would say, is going to be the gold standard still. You're still going to have less fees, no prepayment penalties, but the barrier of entry is going to be higher for traditional financing. Borrowing money in your IRA, I can't ever interact with your IRA. You have to go to a non-recourse loan, and you can just Google that and you can find some non-recourse lenders to let your IRA borrow. You may have some taxes with that, so talk to your CPA or your IRA administrator and find out what that looks like. Commercial loans and lines of credit, they're typically going to be 10 to 20 year terms, maybe amortized for 20 to 30 years, but they're normally going to have a balloon. A lot of times you see 5 to 7 year balloons, actually. The banks, the smaller banks, they don't want to be in bed with your money forever. They want to take a look again in a few years. That's why they do the balloons. They just want to have an out. But the cost of money, again, that's come way down too. It's almost as competitive as mortgages because there's cheap money out there. And then, yeah, I kind of covered all the, anybody have any questions? I'm going to wear myself out of breath trying to get through these boring slides. Okay, so this is a hack that non-QM. I'm not going to go into details on non-QM. That's boring. How to acquire rental properties with no money out of pocket. So this is a hack using hard money. Okay, so you can pick your favorite hard money lender. One of my favorite hard money lenders is sitting right there on the screen waving her hand. So you want to talk to your hard money lender, and there's a benefit for doing hard money loans versus using me to acquire a property. When I acquire a property, like we saw on the first slide, you got to put down 15 to 20%, right? So that's the start. And then you've got to put your repair money into the project. So in this instance, we're going to look at this no money out of pocket option. So property ARV 150. Let's say you find this gem of a property for 60,000. This is harder. I'm going to admit this is a harder thing to do. It needs 40 grand in repairs and you think it's worth 150. I still see these happen all the time. So I know it's out there. It's just not nearly as frequent that I've seen as in past. So if you get a hard money loan, your purchase price is 60 grand, your repair cost is 40 grand. See if you can get 100 grand. Now, Wendy might want some skin in the game. She might not give you 100 grand, especially if it's your first deal, but she might go down to, hey, let's do 10% of the total cost, or some places I see want 10 or 20% of the purchase price, but then they'll cover all the repair costs. So you can negotiate sometimes with companies on how much of a loan you can get. But in this instance, if you can find private money or hard money for 100 grand, you're literally buying this property with no money out of pocket, or very little as compared to what I would need, right? So even if Wendy wants 10 or 20% of this skin in the game, that's more financing to you instantly than I could provide for you, because I can't add that repair cost in like Wendy can. And then once you've got that loan done or that project done, you refinance that hard money loan. There's not a seasoning period if I refinance a loan as a rate and term refinance, meaning I don't give you cash in your pocket. I can use the new appraised value 2 weeks after you finish rehabbing a property. If you want cash in your pocket, you have to wait 6 months for me to use the current appraised value. So there's a big difference between a cash out refinance and a rate and term refinance. And that's why I love hard money to acquire. Let me transition that hard money loan into long-term financing right away. And now you can go do 3, 4, 5 projects in a year instead of 2 if you use your money to do the repairs, and then you want your money back. Because people always call me and say, hey, Bryan, I just got a house, I rehabbed it, I bought it for 100, I put 100 grand in, I want to refinance, I want to get my 200 back. It's worth 250 or 300 grand. I said, great, when did you buy it? Oh, I just bought it 2 months ago. I said, great, call me in 4 months and I can help you. Right? So your money's tied up because you've got to wait 6 months. But if you use hard money, you cut out that seasoning requirement. I can just do a rate and term refinance. If you can get a hard money loan with no payments, I can finance all of the interest throughout that hard money time. So you can put as much money into that as you want. You can put all your closing costs, you can put your interest cost, you can put the closing cost for my loan. It can all be in that hard money loan as long as it appraises. Wendy, I saw you on mute. You have a question?
I wanted to say this, and I'm not helping myself out by saying this. You really need to, when you're trying to decide whether you should do hard money first or just go into a loan like yours first, Bryan, is you need to, it all really depends on the amount of the repair cost. Because you've got to weigh out how much money do I have to bring for the hard money closing versus how much money I'm going to have to bring to the table for a conventional loan. Because if you don't have a whole lot of repairs, if it's a light cosmetic, you might be better off just going with your long-term conventional loan than doing 2 closings, because you may end up bringing more out of your pocket on the hard money side. So you just really need to run both those numbers. I'd be happy to run those with you and let you see.
And that's a great point. If I can close in 3 weeks on the purchase, and that is your only loan that you need for that property, the cheap way in is to use me first, right? If it's a lipstick job, if you only need 5 grand, 10 grand of repairs, and you didn't want to finance that, then absolutely just do the purchase with me and cut out the second close. This is really ideal for those big repair costs where you want long-term financing on those repairs. So I would say for this strategy, the other thing is, if you're not going to greatly improve the value, so let's say that this is a $100,000 house and your repair cost is 40, so you're into it 100, and then it's only going to appraise for 110 or 120. You didn't really allow yourself extra financing. You're still going to need money in that pocket. When I do a refinance, I can only do 75% of the value of the home. So in this same instance, if we did 120 total price afterwards, not 150, I can only get you to 90 grand in financing anyways. So I've had customers come to me and say, hey, I did your strategy. I bought the house, I used hard money, and I want to refinance out, but they didn't improve the value enough to hide all that money into the hard money loan. So in this instance, you're still going to be into this project some cash because we didn't get the ARV high enough for us to take advantage of putting it all in the mortgage. So that's a great point, Wendy. Thank you.
Hey, one more quick question here. So when you're talking about your short instant no seasoning option, are you getting back just everything that Wendy provided, or are you getting all that plus whatever she made them put down as a down payment?
I'm a rate and term refinancing. I'm only refinancing the loan, and I'm putting new closing costs in. So when I refinance the existing loan, I can finance any interest due. So if Wendy said, hey, we can do no payments until closing, you might have 6 months of interest. That's going to be another 5 or 10 or 20 grand that we can finance in long-term. So you can finance any costs associated with the loan and the new closing costs you can finance in, but I can't give you, technically I can give you 2 grand cash back. That's the most cash I can give you at all over your payoff. Okay, so I can finance your closing costs and I can give you up to 2 grand cash back. If the loan size is at least 100 grand, because it's 2%, 2 grand or 2% of the loan size. So,
hey, Bryan,
yeah.
Quick question. So on that, can you roll in taxes and insurance
If they are
on the rate and term?
When I'm doing the new loan, I'm going to put in escrows. When I set up my loan, I'm going to make sure we have enough escrow money for next year's tax bill and next year's insurance bill. And that's not normally going to be in your hard money loan. Most hard money loans don't escrow, but we can finance the setting up of the escrow. So yeah, if you got taxes due, let's say you got taxes due, you just bought the house in August and the year taxes are due in September, I can finance this current year's taxes into the loan. So absolutely, yeah. Now, insurance, if you paid for the insurance at closing, I can't give you back extra money for the insurance, your original policy, but I can set up escrow for the renewal.
Yeah, because some of the non-QM, we can, we can roll in all the taxes and insurance, the hard money loan, and up to 2% cash back.
Yeah.
In terms. So you can get, as you were saying, if you do it right, you can get all your money back and some cash back, up
You
to
can.
80%.
Yeah, whatever you can bake into that first loan, as long as the loan balance at closing, right? It can't be a second funding. It can't be a second loan that you do after the original purchase. It has to be the loan size at the time of purchase. Whatever you could put into that first loan, I can refinance, and I can add in the new tax bills and insurance bills, all the closing costs, and up to $2,000 cash back. So yeah, you can really play with the numbers and kind of try to maximize the amount of finance you can get. And again, when the rates are this low, I want as much debt as possible, right? So I want to finance everything I can.
So what I'm trying to think of is I can't let payments not happen till the end.
Right.
I'm wondering if we were to escrow those payments at the closing, at the original closing, if we were to escrow those payments, if that would work.
So you're going to finance the next 6 months of payments into the loan. That would absolutely work.
Okay. All right.
Now you're going above your loan to value guidelines if you're doing that,
Right.
right? Because that's extra money that's on top of all your other numbers. So if you're able to work that, then sure.
Interesting.
Yeah. Home opportunity mortgage. I'm just going to go over this slide really quick. Essentially, you can buy a house for your parents if they can't qualify on their own. And when you buy a house for your parents, you're going to buy it at owner occupied rates and owner occupied down payment, which right now is 5%. So you could get low to mid 3% rate on a property you don't live in. This is the only property you don't live in that you can consider a primary residence. And since it's a primary, even if you have 10 mortgage properties, you can go get a house for your parents. I do have to verify that they don't qualify via income. So I need to see their tax returns or their Social Security award letters or their pay stubs. And as long as they don't qualify, you can buy on their behalf. They don't have to be on title. They don't have to be on the loan. They get to live in the house. You can charge them rent or not. It doesn't matter. The downside is you have to qualify for this house on your own income, right? But you can get a gift for the down payment. They can gift you the down payment money. So it can be their cash that buys the house because you're allowed to use gift money on this purchase. So it's a little used mortgage, and it's not an actual mortgage that you can't go Google. If you Google it, you're going to find a little exception in Fannie Mae's underwriting guidelines, but it's just an exception policy that if you're buying it for your parents, you can do that. Now you can't do it for kids unless they're disabled. But with kids, I'll show you another way to buy a house with better rates. Second homes as an investment. So Fannie Mae says a second home is a house you're going to stay in some of the year. But some is the only word that they use to define how much you have to stay in it. So some of the year could be a day, could be a month, could be a week, could be twice a year, it doesn't matter. As long as it's some of the home. What you can't do is put an annual tenant in that house. Because then you got to knock on the door, midway through the lease, and be like, hey, can I stay on your couch? Because I gotta stay in this house some of the year. I know it's awkward, but you're doing me a big favor. Thank you. So you should finance. You should furnish these properties. You should have the ability to go stay there at some point. But you're allowed to Airbnb or to short-term rental these properties. That is 100% allowed. You just can't use that income to help you qualify. So this mortgage, you have to qualify on your current income, and we can use all income streams, your W-2 jobs, all your net rental income, we can use all that. Today's best rates, this actually has gotten better since Fannie Mae dropped that restriction of how many we can do. We're down into the low threes now, probably 3.375 is a really good rate for a second home. You are limited to 10 financed properties on second homes, but you can have multiple second homes. I started the slides off with, I have 4 second homes, and you can have 2 second homes in the same city, close proximity to each other. That's allowed. What you can't do is have it be in the same neighborhood that you're in or the same community that you're in. So I'm in Waxhaw. I can't just go buy a house in Charlotte and call it a second home. That's not an escape. I'm not getting away to Charlotte, right? But if it was a lake house, or I could probably get an underwriter to buy an uptown condo, hey, I want to go see shows and sporting events, and I am escaping because it's a destination now, even though it's in close proximity. There's not a defined rule of distance. A lot of mortgage lenders will say 50 miles or 100 miles. That is an arbitrary number. It just has to make sense. If it's 20 minutes away from you and it's in another neighborhood, it's just not an escape. So, but second homes, 10% down versus 15 to 20 on investment. I like buying second homes because it's better rates and it's better terms. For down payment money, I like as much debt as I can possibly get right now. So Lori and I, last year, we started concentrating on buying second homes, and I'll continue to do that. Side note, Wendy, is the second home rental market really, really hot right now?
And, I couldn't tell you because I don't dip into that market, the second home market.
Well,
real
are
estate
short-term
agents-
rentals in general?
Oh, they're huge. They're huge. It's scary how huge that is. And I would imagine, yes, that most people are buying as a second home for short-term rentals, and they're everywhere. Destinations are just being flooded with short-term rental people.
Yeah, the thing you've got to be careful with is the guidelines and policies can change. A city ordinance can pop on as soon as they want it to. So we've got a house in Denver, Colorado. You have to do 30-day rentals. You can't do shorter than that because of a city ordinance. I'm buying a house in Leadville, and I didn't know that they have the same rules. Essentially, they grant X number of licenses per year for short-term rental. And if you don't get a license, then you've got to do at least 30-day rentals. I didn't know that. I think it'll work as a longer term rental, and I'll apply every year to get my short-term ability. But you got to just make sure your numbers work as a long-term rental in the event that you can't do a short-term rental.
Well, the other thing you could do is do 30-day rentals. And Al Williamson, who is an awesome guy, spoke here before, does nothing but 30-day, 30, 60, 90-day stays. We'll talk about that later. Do you see the question from Laura? Could a second home be outside the USA?
It could be, but I can't finance it. The way I finance properties, I'm licensed per state, and I can only lend in the states that I'm licensed in, and I'm not licensed anywhere out of the country. So you'd have to find some entity that could lend, and then you'd have to check their guidelines.
Right.
Now, US territories, you can get licensed in. You can get licensed in Puerto Rico. You can get licensed in, I think, part of the Virgin Islands. I'm not licensed in any of those, so I can't help with those. And I've heard some of those like islands, you've got to really find a local bank that specializes in it.
Tom has a question, but I don't know which Tom that is.
It's me, Wendy.
Go ahead.
Bryan, I mean, as I listen to this, I guess it brings, because I'm so old, it brings me back to 2006 and 7 and 8, where, all of this creative financing and all of this debt and et cetera, that you could get on. I said, after the 2008 crash, it was one where regulators kind of, clipped everyone's wings and didn't let you get above ground level. But now it seems as if we have this exuberance and there's so much money out there that, they're looking the other way and you can do all of this. Is this something that's, is this another ledge that the economy is getting to when money seems to be so free at this time and you can almost do whatever you want to with it? Because I've always been one that I never felt like debt was good, but yet your statement is debt is good. You don't want to pay off debt. You want to have as much as you can and see where it goes. That I guess that kind of conversation with me caused me to pause as to where are we headed with this.
So it's a great point that you bring up, and I see debt as a tool. It allows me to leverage over time. I don't have the money to buy 4 investment homes right now sitting in my back. I might buy one, but then I'm out of money. So debt allows me to extend what I'm able to purchase. And if you look at the cost of debt right now versus any other time, even if you're at 5%, that is historically very cheap financing for investment properties. And, if you listen to Dave Ramsey's out there, they started preaching get out of debt when mortgages were 10, 12, 14%. Mortgages were not in the 3 to 5% range. So that debt was not healthy back then. But this debt, if your debt is the equivalent of inflation, I see it as free money. right? Because your inflation after a couple of years, you're going to earn more just because everything has gone up in cost and value, except your payment. Your payment has been locked in. And in 20 years, the payment that was a little hurting right now is like nothing. You're like, man, why didn't I borrow more money later? So I see the opportunity, this window of debt, as being great because it's transformational. It's allowing so much acquisition to happen at such cheap cost that it's going to make it so I don't have as hard of a time covering the mortgages, right? Because the debt load is so much lower. And then the other point is it's still hard to get money. I still have to verify that you make enough money, you have enough reserves. The underwriting guidelines are hard. And anybody who's recently gotten a loan will be like, oh, when they say, how was underwriting? You know, because it's a lot of documentation. Where in 2006 and 7, yeah, how much do you make? Okay, I'm going to write that down. Don't give me any docs. We're good to go.
Yeah,
Right.
fog
And
this
you can get a,
mirror.
what's that?
Fog this mirror.
Yeah, if you fog a mirror, you're qualified. We'll make it work. And I had, back in 2007, I worked for a bank that did stated income and stated value for a home equity line of credit. Stated value, what do you think your house is worth? 400 grand, done. So, right, stated value, if you wanted $50,000 or less, you did the application today, I closed tomorrow. We did a quick title search. That was the only work we did. That was crazy.
Yeah.
It is not like that right now. So
Remember the 125% loan to value.
right.
And the options, the 4 options that you could choose to make a payment that was even less than interest only. So you were adding even more debt onto your mortgage. It was crazy. We just don't have loans like that at
Yeah,
this
my-
time. Thank
And
My
the
God.
wife bought
appreciation
her-
wasn't as high as it is now, right? But they were banking on, well, in next year or in 2 years, there's so much appreciation, you won't be upside down. And we didn't have appreciation levels like we do right now, but we're still very restrictive in the conforming loans, the loans that I do. It's still a lot of paperwork to get approved, and it's hard, you know, it's full doc.
The other thing too, Tom, is I want to make sure that everybody heard what he said, because we should all use caution and understand that history repeats itself. For, thousands of years, we've been seeing that history repeats itself. So yes, use caution on every single thing that you do, and make sure that you always not only have a plan B, but a C and a D. You've got to look at everything as if it's worst case scenario. So nobody's poo-pooing what you're saying. I promise you that, Tom. I'm all about caution myself, but go ahead.
Joshua, you had a question.
Oh, no, I was just gonna add that, back in 2007, before I met my wife, she actually bought her first home, and they pre-approved her for $500,000 on a $45,000 annual income.
Wow.
Yeah, so that would never happen today.
No, that's $3,700. Right now, the most debt you could have is $1,800 a month on, and that's if you've got good credit, right? So $1,800, including student loans, car loans, and the mortgage. So no, that would not happen at all right now.
But there are some options coming onto the market that are giving you 10 years interest only and then revert to a fixed rate that you lock in today that can let you go 30, 40 years now. And that allows you to take a property that might be break even at best and make it cash flow for a period of time. And then
Yeah, and
turn
that's going to
around
be
and
the
sell it down the road.
non-QM or that commercial lending. That's not Fannie Freddie. Fannie and Freddie don't
Right.
allow interest only payments at all. It's not legal. So it has to be to your LLC. And I would imagine you're putting down not 5% on that mortgage, right? You're probably
Sure.
putting 15 to 25% down.
But those options are out there, and if they make sense after holdbacks, then that might make a property make sense that wouldn't otherwise.
Sure. Yeah, there are some creative options, but they're not to homeowners. They're not to Bob and Joe, your next door neighbor anymore. Those are to your more savvy real estate investors who hopefully understand this is a creative option. It does carry a little more risk, but the average Joe can't get access to that same stupid money, right? We'll call it. So in second homes, I'm a big fan of. It's only a second home while you're buying it, by the way. Once you own it, it's on tax returns as an income producing property. IRS and Fannie Mae look at things differently. So if I bought a second home today and next year I was buying another second home, I can use the rental income from this second home I bought today to help me qualify for the one I buy in a year. So it's on tax returns as income producing. So I can now use that income to qualify for my next mortgage. Primary home as investment. This is what I did and my family did. You buy a house and then you move out of it. 12 months. You have a 12-month occupancy clause. You can buy investment properties, but live in them, and now you get better rates and terms. If you're not going to live in them, you can co-sign with somebody that is going to live with them. So I said you could do this for your kids a different way than your parents. The different way is you put your kid on the loan. Now there's some qualifications. Your kid can't have crappy credit. But guess what? Most kids don't have access to credit like they did when I was in high school. And I got my first credit card in high school. That was stupid, right? But people came out of college with 14 credit cards because every game they went to, there was somebody else hawking towels and you know, student gear or whatever. And they're encouraging them, you don't have to make payments on this until you graduate, right? Just go spend, spend, spend. Nowadays, kids don't have access to credit like that. And a lot of kids' first credit cards is a cosigner on their parents' account, or it's a cash secured card. Maybe you've got some Discovers and some store cards you can get. But for the most part, an 18-year-old is a good bet to put on a mortgage. They probably don't have bad credit. If they have no credit, it's ideal because then we just use your credit. Their credit has zero, them having no score has zero impact on the application. But if they do have credit, the lower of the two of your scores decides the rate. So I love no credit. I think that's the best because it can't negatively affect you. Put the kid in, and I always say kid, but it doesn't have to be a kid. It could be your 35-year-old nephew who just has never owned a home and is off the radar and doesn't have credit or doesn't have bad credit. But you can co-sign with someone that's going to live in the house. They don't have to have income. They don't have to have assets. They don't have to have credit. It's all based on you qualifying. They're just the key to calling it owner occupied, right? Because they're going to live in it for 12 months. The first time they buy a house, everybody is entitled to 3% down if one of the borrowers have never owned real estate. So you can always do 3% down. And your next purchase, you have to do at least 5%. You can do FHA and it's 3.5% down, but they look at income for a non-qualifying borrower much different. You can't do an FHA loan with a borrower has no income and is going to live in it. It doesn't work the same. So you got to go Fannie Mae or Freddie Mac for this. But it's fantastic. Now I've talked about this method for about a year or two, and I hadn't found the right person to do it with myself. I kept trying to talk my niece and nephews into doing it, but their mom is anti-real estate, I think, because she's crazy. But she thinks it's all about me and I'm taking advantage of them somehow. And so I have a niece and nephew that are renting right now, and it pisses me off because it's like, God, let me buy them a house, right? And let them house hack and have cheaper rent. But mom is too involved. But I have a close personal family friend. We bought our first property like this. She's living in it. She's 20. She set up all utilities. Let me say this again. She set up all the utilities. If you guys buy a house, you know how much work it is to set up utilities, to furnish it, to find tenants. Guess what? She's doing that. I outsourced everything to her because it's her house. So it was extra hands and boots to you know, we had a dishwasher, a dryer that broke. Call some people, right? Like I give her the phone numbers. I don't have to call them. I don't have to schedule it. I don't have to be there. She's doing all that. So it's even better than a second home because I got someone living in it that cares about the house. So it's great just to have that extra person take off some of the work off of our shoulders. But this is a very creative way to buy investment properties. So she'll live in it for 12 months. She's already got 2 roommates that are paying 2/3 of her mortgage. So she's living cheaper than she would otherwise. She doesn't own any equity yet because she hasn't made any payments. But her intention is that she'll buy into the equity. But even if she doesn't, when we sell, I take all the cost out. I take all everything out, and then I split the equity with her and I split the profits with her because she enabled me to get cheap financing and she enabled me to get another house. If I had 10 mortgages, I could still do this because this is a primary residence and you can always buy a primary residence. So it's a way to go above 10. Get creative, man. All right, I'm going to skip these slides because I found some other stuff that I wanted to show you guys. Some people have heard me say that equity is like unemployed Benjamins. Wendy, who's Benjamin?
Benjamin Franklin?
That's the guy. So equity in your home is unemployed $100 bills. They're just sitting around looking at each other, right? They're like, hey, what are you doing today? Nothing. What are you doing? Nothing. They're not making you money. They might be saving you a tiny bit of money on interest, but they're lazy unemployed Benjamins, and I don't like unemployed Benjamins. Well, look at this chart. This is, can you guys see this, or did I blow it up a little bit? There. This is the amount of home equity in housing right now. And this is 24,000 billion. So this is billions of dollars. There's 24,000 billion dollars in home equity. You want to see what that looks like? So 1 billion is that times 24,000. Look at all those unemployed Benjamins. That's $24 trillion of home equity that's sitting around looking at each other doing nothing. Crazy? All right, so what's going to happen? We all know that houses have appreciated over the last 12 months, 20%. CoreLogic says 18.6. Some other stats say 20%. So we're right in that area. Well, Zillow, as of last month, I think this was September based, maybe it was August based. Zillow is saying that in the next, so in the last 1 year, it was 18.4. But they say in the next 13 or the next 12 months, we're going to see 13.6% appreciation. I hear bubble a lot, a lot. Are we in a bubble? Should I buy? What if today is the cheapest that you can ever buy real estate again? It might not be, but Barry Habib says that we are not going to see an issue with this market. The reason is the average homeowner right now is 33 years old. This is today. I showed this chart 2 weeks ago, but it's worth showing again. And we've got for the next 4 years, 3 years, more 33-year-olds that are coming of age that are going to be buying their first home. And then it starts to taper off a little bit. And for the next 7 to 10 years, even while it's declining, it's still higher than today, right? And housing is not being built as fast as households are being created. That's inventory issues, that's supply and demand. In 2007, Tom, we were building 1.2 houses for every one household being created. And the reason for that was we had this uptick right here in inventory, and builders are building to demand. Well, then we have this major drop off, which we talked about a couple of weeks ago, was Roe versus Wade, right? So once abortions were legalized, we saw a massive decline in population, in births. But we're not going to have that issue come up again because we just turned that corner and it's just going to keep getting more and more. So I don't think, because builders are building right now 0.8 homes for every household that's created, they're not catching up. They're getting further behind. And we're seeing that nationwide with inventory shortages. So if we take all this unemployed Benjamins and we see projections that we're going to likely see it. I did a quick exercise, and then Wendy, I'll be done because I know I'm at my time. But I wanted to talk about opportunity cost. All right. What is opportunity cost? Anybody? Like general definition.
Are you talking about the time value of money?
Just everything has a cost, right? When we buy something, it has a cost. When we don't buy something, that also has an opportunity cost, right? That thing that we were going to buy might have appreciated. So our opportunity cost is we didn't buy when we should have, and it's now more expensive. Or we bought something that could be gaining in value. So by not buying it, we're losing money by not spending money. So there's cost and then there's opportunity cost. We always look at the cost, but I don't think many people look at the opportunity cost. So I wanted to show you what opportunity cost looks like on a house. And I get this a lot. Oh, I can't touch my mortgage. I got such a great rate. Great. Let's talk about your great rate. So just threw up an example. Some people might be 2.5, some people might be 3.5. But let's say you have a $200,000 mortgage at 3%, you're spending $6,000 a year. And if I come to you and say, you know what you should do? You should take some money out, take 100 grand out of your house. And that's going to raise your rate, I exaggerated, to 5%. Wendy, does that sound like a good idea?
It's kind of scary, but
Okay, so let's
cash in my hand is always better.
so let's take a look at cost and opportunity cost. So here's the cost. We went from $6,000 a year in cost of this money that's outstanding, 200 grand, to $15,000 a year. If you get a $300,000 mortgage at 5%, I can't give up my good rate though. Well, let's look at the opportunity cost. So we know the cost is $9,000, right? Agreed?
Right.
So let's say we take that 100 grand and we buy 2 second homes, because you could do 10% down on a second home. So let's say we buy a $500,000 home, and let's not use Zillow's forecast. Let's not use this year. Let's just say we're going to appreciate at 5.5%, which I had heard is what the National Association of Realtors says average appreciation is since the 1960s. Right? Now, I've seen other stats that were lower. I've seen some that were higher, but that's the number that I typically use as average. I think it's a fair average appreciation. So if I get a house for 500 grand and it's got 5.5% appreciation, I earn $27,000 in equity. And if I bought 2 of them, that's $55,000 in equity that I gained in the next year. But Brian, there's a cost. I'm going to pay $9,000 more in interest on my mortgage. Yeah. I'm going to ask, how many times can I do that? If I can turn 9 grand into 55 grand.
But those are non-working Benjamins if it's equity in a house.
This is the equity that was in the house right here. This was $9,000 of non-working Benjamins that you saved. But I put them into a $500,000 appreciating asset. That's the nice thing with real estate is you can compound. If I took this 100 grand out and I put it in the stock market and I was earning 8%, right? I would earn $8,000 in a year, but it cost me $9,000. So I can't just take 100 grand and invest it and hope to get return on that. I got to compound it. But by buying a real estate, I can turn 100 grand of appreciating asset into 500 grand into appreciating assets.
And if you're short-term renting it, there's income off of it too.
I'm not even talking about the rent, right? I got a property that earned $28,000 2 months in a row in the summer. It's a lake house. I'm not counting that income. My mortgage is like $2,400. I earned $28,000.
Wow.
This is not looking at that at all. It's only looking at the appreciation. And this is looking at 5.5% appreciation.
Wow.
Now, let's say you did this a year ago. Brian, I know rates are at 3%, but I want a 5% mortgage. I want to get some extra money out and I'm going to buy a house. So if I had $1 million in homes appreciating at 20%, I earned 200 grand.
Wow.
How many times can you turn $9,000 in extra interest into 200 grand? I want it a lot, right? So there's opportunity cost that's out there. And I put in here, not counting cash flow on that first thing, it's actually 46,000 is how much we turn $9,000 in interest into.
Wow.
And I just don't see anybody talk about that. So yes, Tom, it is dangerous to go into debt and to leverage. But when I do this cash out refinance, I can only go to 80% of the value of your home. If it's a primary residence, if it's an investment property, I can only go to 75%. And what if it was my primary home at 3% and it's now investment, but I got a bunch of equity? I hear all the time, well, I don't want to touch that mortgage, it's so low. And I'm just looking at all these unemployed Benjamins thinking, you're costing yourself money. And I love hearing, well, I'm going to wait till the market crashes. I love hearing that because I just think, man, that means you're going to have a lot of unemployed Benjamins for a very long time. I've heard people say that they are liquidating some assets and they're preparing for a downturn. But guess what? When we look at this chart, this is the amount of home equity in homes. These gray lines are recessions. Okay, these gray bars. And look what happens to the value of real estate during the gray bars. Flat, up a little, up a little, up a little, up a little, flat, up a little, down a lot. Guess what this recession was caused by? Housing.
Yeah.
right? So this wasn't a recession that tanked the market. It was the market that tanked the economy. That's the only time we've seen a really big downtrend during a recession. Here's a little recession. Remember this? This was called COVID.
Mhm.
It was like 1 month. Now, because this little mini recession, which was COVID, was only 1 month, it's highly likely we're going to see an actual recession coming up. And that's what Barry Habib is talking about. He's saying the next 12 to 18 months, we're going to see a recession. But if we have a recession, what does that normally do to the interest rates? Drops them. That's right. And what happens when interest rates drop? What happens to home sales? Look at all this. It's either flat or up. This whole year it's flat or up. So if we see a recession, interest rates might drop. That makes more access to cheap money. And you might be able to go buy some more homes because appreciation might level out, right? We never saw fantastic growth during a recession. If you think we're in a recession now, maybe there's fantastic growth. But hopefully homes appreciation levels a little bit. We've got a lot of 33-year-olds coming up. And so I just don't see the bubble coming, Tom. That's me personally.
Wow. Wow. That is such good stuff. This is the best way to get in touch with Bryan. It's just so if you pay big money for masterminds, let me give you a clue. This is the kind of information you get. And how much did you pay for this call today?
Are Benjamins coming my way, Wendy?
That's right. They are, but they're coming from God.
There you go.
For sure. Does anybody have any questions? Now's a great time to unmute yourself and shoot some questions out.
Bryan, this is fantastic. I sent Wendy a private chat. We need you every week. You just, I mean, all these numbers come close to you, and it's basically kind of away from just conventional thinking that what you're doing, and this is awesome. It's how can, because we have you in our group. I don't think we utilize you as much as we should, because the scripture says your ways are as high as the heaven is above the earth. And I'm thinking things that you're saying is not something we hear every day.
That's the truth.
Thanks, Tom. I appreciate that. I always am fearful that what I talk about doesn't hit everybody, and it's not going to hit everybody. Some people, they have a hard time getting traditional financing. I get that. But
I can't get it. I can't get it.
There are a lot of people, Wendy, that can't get it.
Yeah. I
In
wish
2008, you could get it though, right? Or in 2007?
2007 all day long. But
It is different right now.
Yeah, I pay a tax guy big money to make sure I can't get conventional loans.
I love it.
But
it ensures I can't get conventional loans.
I'm sorry.
I said I took a job that ensures I can't get conventional loans, at least for 2 years.
It's there are a lot of people that can though, and I think this is really, and not only is it good information if you're interested in getting a loan, but we need to understand in depth what's going on in the market. And when you're sharing what you're sharing, Bryan, this is information that, you're not going to see this on even Fox News or CNN or anything. You're not going to see this information. Everything's going to be touted one way or the other. And it's good stuff. And I've got, can we have a copy for a recording for this meeting? The answer to that is yes. I actually have a marketing person that starts on November 1st that's going to straighten out the Dropbox so that everybody can get into every recording that we have. This particular recording, I will have my outsourced marketing person send out to the Sonrisers list this recording, so you'll have it. And I'll also put it on our Sonrisers Facebook page, so you just click on the link and you can get it there as well. Bryan, good stuff, buddy.
Thanks, Wendy. Thanks for letting me speak. I appreciate this group so much. When I left the retail bank, I knew banks could only do 4 mortgages, and I was going to a mortgage company. I knew I could do 10. And so my first thought is, what pond can I fish in that other bankers aren't fishing in? And I hardly ever see other mortgage people in RIAs. Brian, I love seeing you here, man. Because they're just not thinking about investors.
Mhm.
Investor loans, I have a client that has told me many, many times, he calls them, I'm going to clean it up because it's Sonrisers, dog crap loans, right? It's 50, 60, $80,000 loans, a lot. But once you get an investor approved, you can do several of them, right? Because we've done most of the paperwork. And most investors, I don't do just one loan for, I do multiple. And then sometimes I get a crack at their primary, right? So that's not the dog crap loan. That's the bread and butter loan. I don't mind small loans. I love real estate and I love helping. And so I knew I needed to get involved in RIAs. And so I got licensed in October. I joined the RIA in November 2013. I've been a member since, and I've learned so much just listening to everybody here. And I hope that I bring just a different twist on boring financing. So hopefully it's been useful for you guys, but thank you for letting me speak, Wendy.
Thank you. And you need to stop calling financing boring. I think it's the most exciting thing on the face of this earth.
It does pay the bills, I guess, right?
It's bread and butter, as you put it.
I'll just add this, I've done quite a few personal traditional financing deals over the years, and I've met some guys that think a little bit outside the box, but I've never met any traditional lender that thinks as far outside of the box as far as how the rules actually work based on the way they're written versus what they think that they can do and or can't do. And I've just never met anybody who thinks as creatively as you do with traditional rules and traditional financing.
Yeah, I agree. Well done. Well done. And keep in mind too, that, you may think financing is not the most exciting thing in the world to talk about, but financing is what sets you free in this market. Being able to get leveraged is the only way that you can really do this business. If you're waiting on cash for every deal that you do, trying to do cash, you'll paint yourself into a corner. You'll keep yourself from being able to buy new things. And one bad deal can take you down. So leverage is your ticket to freedom in this business. So understand it, whether it's the conventional side, whether it's non-qualifying, private money. You need to understand self-directed IRAs and how they work. You need to know all of these tools, because this is what's going to put you ahead of everybody else. And when I say private money, I'm talking about seller financing, subject to. There's so many different ways to be successful in this business, and it's all based on how you can finance it. So it's not really what you're buying it for, although that's important. It's all based on how you're going to finance it. So thank you so much, Bryan.
And don't be afraid of those alternative products. If you can't get the gold standard, there's still plenty of profits to be had. And that's why I wanted to go over some alternative options for you guys. And don't be afraid of, I got this good rate, I don't want to touch it. That's opportunity cost. And I hear that so well, I want to get a home equity line of credit to do all this. Well, guess what's going to happen to that rate on the home equity line of credit? It's going to skyrocket.
Mm-hmm.
You don't spend trillions of dollars every third month and not have it affect inflation and the economy and interest rates. It's not if they go up, it's when. And
Right.
a home equity line of credit is great for short term to get your long-term financing in place. It's fantastic. And I encourage you to have a home equity line of credit. I don't encourage you to buy a house with it and leave it on there, because that 4% rate today sounds great, but it could turn to 8% in a summer, one summer. They can have a meeting every 6 months. And the last 2 times we were coming out of recessions, the Fed started aggressively raising rates, and every 6 months they were going up 0.5 point. And they went up 3 points one summer and 4 points one summer.
Wow.
That can really change your cash flow and your dynamics. So I'm not a big fan of variable interest rates in this market when rates are as cheap as they've ever been.
Yeah. It's actually insane to do that. Awesome. Thank you so much, Bryan. Everybody have a great, wonderful week. I'm pretty sure Jeff Watson is speaking. It's I'll have to look again. I don't know if it's next week or the week after that, but Anyway, thank you so much, Brian. We might get you to do like a 5 or 10-minute market update every Sonrisers. Everybody like that idea? Oh, put him on the spot again.
Great.
Hey, the more you put him on the spot, the more Benjamins flow his way.
That's right.
You may not be paying him directly, but I guarantee you there's plenty of people in this room
I got 4 kids.
that
I
need
need
to be
all the
reminded that
Benjamins.
he can help them.
I need all the Benjamins. I got 4 kids.
But thank you so much. We'll see you next week. Y'all have a great one.